Most people think crypto is all about Bitcoin, Ethereum, or trading tokens. But behind the headlines, something quietly emerging could change the way we think about money, ownership, and finance itself. One piece of this puzzle is real-world assets on blockchain, or RWAs. In this video, we'll explore what RWAs really are, how they're being used today, and why experts are starting to pay attention. By the end, you'll see a side of crypto most people haven't considered, and why it could matter in ways you might not expect. First, let's define RWAs. Real-world assets are physical or traditional financial assets that are represented on a blockchain through tokenization. For example, a building, a piece of art, or even a government bond can be turned into digital tokens. Each token represents a share or claim on that asset. Why does this matter? Because it bridges the gap between traditional finance and crypto. Suddenly, markets that were slow, centralized, or illiquid can become instant, decentralized, and globally accessible. So why are real-world assets starting to appear on blockchain right now? There are a few big reasons. First, the technology itself has finally matured. Early blockchains were great for simple tokens, but handling high-value assets securely and efficiently required improvements in speed, scalability, and smart contract reliability. Today, that's no longer a barrier. Second, the regulatory environment is starting to catch up. Governments and financial authorities are exploring frameworks that allow compliant tokenization, which means it's becoming legally possible to represent real-world assets digitally. And third, there's growing demand from investors. People are looking for new ways to diversify and access opportunities that were once difficult, slow, or expensive. Tokenized assets allow them to invest in markets that were previously closed off or illiquid, and to do it in ways that are faster, more transparent, and programmable. Now, let's take a closer look at how RWAs actually work. Step 1. You pick a real-world asset, like a building, a bond, or a piece of art. Step 2. The asset is legally wrapped, often using a special purpose vehicle or trust, which ensures it can be represented on the blockchain in a compliant way. Step 3. Digital tokens are minted on the blockchain. Each token represents a share or claim on the underlying asset. Step 4. Those tokens can now be traded, used as collateral, or even borrowed against in DeFi protocols. In short, RWAs bring the trustless, programmable, and instantaneous qualities of crypto to traditional assets that used to be slow and fragmented. Of course, RWAs are not without risks. Regulation is a big one. Tokenized assets still exist under traditional legal frameworks, and compliance is essential. Custody and security also matter. Physical assets still need proper management, insurance, and legal oversight. Liquidity can be tricky too. Just because an asset is tokenized doesn't mean it will instantly trade. Demand and market depth are still important. So while RWAs open new doors, investors need to understand that tokenization doesn't erase real-world risks. It just makes them more visible and easier to manage. Despite the challenges, RWAs are already being used in exciting ways. Real estate platforms allow fractional ownership of properties around the world. Some DeFi protocols are tokenizing bonds, making them easier to trade and use as collateral. Even luxury goods and art are entering the space, letting investors buy fractions of masterpieces or collectibles. Looking ahead, RWAs could form the backbone of a more integrated financial system. The line between traditional finance and crypto is starting to blur, creating possibilities that were unimaginable just a few years ago. Like, subscribe, and hit the bell to stay ahead, because in crypto the possibilities are moving faster than ever.